let's get more. Now on the story that's been moving those markets early in the session, indeed has been moving the markets over the last months, with our London Bureau Chief, Mark Gilbert. Mark, thank you for making time for us. It does seem incredible. I mean, this story, we've heard about it for weeks and weeks and months, and yet it's only after we had the borrowing cost at 7% that we had detailed plans. Why didn't get it sooner?
Well, they were hoping that the verbal support would be enough, that the market rates would come down and Greece would be in a position to be able to borrow in its own right, in its own name, on the markets, meet its funding needs at a rate acceptable. That's not what happened. As we saw last week, markets tend to take on a borrower that's in trouble. They smell blood in the water. Traders love volatility. And so what we were seeing was a profit opportunity if you're a trader. So that's kind of forced the hand of the European Union leaders to put up some money, to actually detail how much Greece will pay, how much money is available to it, how long the package will last. At the end, the markets have kind of won in a way.
Now, it also seems that Germany was against a bailout at non-market rates until the very last minute. What convinced them to do a 180-degree turn?
Well, one thing, let's be clear, 3-year money for 5% is not cheap. It's cheaper than Greece will get on the open markets, but it's not cheap. Germany pays less than 1.5%. The US pays about 1.7, 1.8% for 3-year money,
And the
I
IMF
think.
would offer at, what, 3.5%?
Yes, and that's a different kind of package, so it's not cheap. I think at the end of the day, Germany decided the euro is more important as a concept than the individual principles of we do not bail out or guarantee individual member states. I think that they were eventually forced to the precipice by the market, and they've blinked. Problem is, once you blink, markets say, hey, where's our next profit opportunity?
Where is the next also probability of someone else trying to go down?
Portugal is a potential candidate, but what we're hearing in the markets this morning is, you know what the most obvious one is? It's the UK. When Dubai got into trouble, it has neighbours that can help it out. When Greece gets into trouble, it has its Euro neighbours who'll help it out. UK's kind of alone and isolated. It has a deficit of 12% or higher of GDP. Where would you look to next for your profit opportunity? We could start to see a lot of focus on the UK, especially since you've got an election, which is going to cause uncertainty anyway, as we've seen with the pound, the idea of a hung parliament. Seems to me that the UK could well be vulnerable in the coming days.
But why would it be so bad? We spoke to Danny Blanchflower just 10 days ago saying, well, what if we lose, our credit rating? Who cares, he said.
Being downgraded is not a problem, that's fine. Being unable to borrow, having failed gilt auctions, having your interest rates go through the roof, much worse situation.
Yeah, and of course then you get onto a default situation like Argentina.
Spiral time, and then if the markets aren't funding you, who does the UK turn to? Not really anyone there.
Mark, thank you so much for that. Mark Gilbert there. Well.